Are you tired of paying sky-high taxes on your six-figure income? What if there's a hidden strategy that could save you thousands of dollars on your tax bill? Well, in this video, we're diving deep into material participation and how it can be a game changer for your business, especially through real estate investments. Before we start, remember, I'm not a CPA, so consult with one before you implement any advice on this video. And if you're new here, I'm Dr. Jeff Anzalone, a periodontist from Louisiana that's here to get you out of the rat race. Do me a favor, download the passive income guide I've got for you below this video. So let's start off by answering the question, what exactly does it mean to materially participate? Well, this occurs when a taxpayer is consistently and substantially involved in a business. In simpler terms, if you're actively engaged in a business operations, then guess what? You've materially participated. So let's talk a little bit about the difference between passive investing, which I'm invested in a lot of these different real estate syndications. I'm a passive investor. So the difference between passive investing and material participation. Now, when it comes to investing passively in syndications, one of the most common questions I get revolves around depreciation and taxes. Passive loss rules dictate that passive real estate investors, limited partners, myself, maybe you, we can only deduct passive losses that we get from the syndication from the passive income. That rule is actually known as the passive activity loss rule, the passive activity loss limitations, okay? So you get depreciation from a syndication, okay? It could be like a mobile home park, self-storage, apartment, something like that. So you get the depreciation deduction, which can offset the distributions that are sent to us on a quarterly basis, okay? The depreciation offsets the passive income. Any passive losses exceeding those distributions actually rolls over, be carried over for the next year. So it's not like you have to use it or you lose it, okay? Now, remember that, and then when we get into this material participation, I'll kind of let you know about how both of those kind of work together and the difference between the two. Because to materially participate, remember you have to be actively involved in a business, real estate business, something like that. You actually must have to pass at least one of these 7 tests to determine your active involvement in a business, trade, or other income producing activity. So again, if a taxpayer passes one of these tests, they qualify as a material participant, which allows them to deduct business losses from their tax return. They can get losses from, so if they materially participate, they could potentially deduct the losses even from depreciation. You can deduct that from your W-2 income. Okay, so you're actively participating. So test number 1, did you spend 500 hours on the real estate activity during the year? So again, you don't have to pass all these, just one. The second test, did you spend more time on this activity than any other individual and more than 100 hours? Third test, did you spend 100 hours on the real estate activities and make a grouping election? 4, were you the only participant, or did you materially participate in this activity for any of the 5 of the past 10 years? Test number 5, did you materially participate in personal service activity for any of the 3 previous tax years? Test number 6, did you spend 100 hours on this activity and no one else spent more hours than you? And last but not least, did you meet the facts and circumstances test, spending at least 100 hours on the activity and meet other requirements? So once you understand that if you pass any of these, then you become a material participant. Once you understand this, then you can either become one of 2 things. And this is how you unlock the secret to tax savings, even if you're a high income professional, okay? So once you understand these rules, you can either become number 1, a real estate professional. Number 2, you can actually use the short-term rental tax loophole to reduce your tax bill, all right? And we've talked about both of these in the past. Very quick review. To qualify for a real estate professional or rep status, you must meet these conditions. You must spend the majority of your time, more than 50%, in real property businesses in which you materially participate. So now you don't have to figure out, well, okay, well, a lot of times I get physicians and dentists, they'll say, well, why can't I invest in the syndication? Why won't it offset my active income? And then I talk about, well, are you materially participating? Like, what does that mean? So now you know if you pass one of these 7 tests, then you will be a material participant. So that would be the first thing to qualify. You have to spend more than 50% of your time in the real property business in which you materially participate. Number 2, you've got to spend minimum 750 hours or more in the real property business and rentals in which you materially participate. This comes out to be roughly about 15 hours a week. You're materially participating 15 hours a week. If you do that, then you can have your accountant, there's just a little box on your tax return where they check off that you qualify as a real estate professional. And when you do that, then it will automatically take in the losses, offset your active income. You pay a lot less tax. Heck, you may even get a refund. All right. That's number 1. Number 2, similar to becoming a real estate professional with the short-term rental tax loophole. So you must also materially participate in this short-term rental business or Airbnb, anything like that. Okay. So this strategy defines exceptions to the definition of rental activity. So essentially, if you follow the rules, then income from a rental property can be excluded from the definition of a rental activity, and thus it's not automatically passive. Typically, rental income is automatically considered passive. If you do what we're getting ready to talk about, then it will not be passive. It will be to the point where you can materially participate, and it will be an exception to that. So here's how to take advantage of this strategy. Number 1, you purchase a short-term rental. Number 2, you materially participate in the rental business by passing one of these 7 tests. Number 3, you order a cost segregation study. I've got articles on this. I have other videos on this, but basically you hire an engineering firm and they come out and they take a look at your short-term rental and they segregate out the cost. So now they can look at the different parts of your short-term rental to depreciate on an accelerated schedule. You can get most of your depreciation within the first few years. So whether that be the landscaping, the flooring, the drapes, the cabinets, that sort of thing, those sorts of things, according to the IRS, actually wear out a lot quicker, right? Those aren't going to last the typical 27 and a half years, which is straight line depreciation. So you order this cost segregation study, then you can take that study and you can use accelerated depreciation that you get from the study that they're going to give you. You can actually use that during the first year that you purchase it. You take that, then you're able to claim paper losses from your short-term rental. And then you just simply make sure that you're working with your CPA who understands this. So sometimes people, for example, they may know that they're having this big tax bill. It could be, they may owe, let's say, I'm going to owe $400,000 this year to the IRS. What can I do? Well, perfect strategy. You can get the short-term rental, you can follow this, and then you could actually severely lower what you're going to pay. Plus, guess what? You've got somebody that is paying for your vacation home. Okay. You have a short-term rental. You have somebody in there that is actually doing that. Plus, they've helped you offset all this taxes. So again, if you know how to play the game, that is what is going to help you out. If not, you're going to keep going and working, trading your time for money, and you'll be making a good income. But if you stop working, the money stops coming in. Plus, all of that money that you're making is getting severely taxed. Or you can work smart and educate yourself, which hopefully you're doing that from this information, this video. Educate yourself on that. All right. So why should you materially participate in a business? Now, again, everybody's financial situation is different. In the LLC or the LLP that you potentially are going to materially participate in, you can deduct the full amount of business losses on your tax return. Now, if you're seeking a way to significantly lower your tax burden, then consider doing this. All right. So, for example, let's say that you own a 35% share in an LLC that incurs a $100,000. You get a $100,000 loss in that given year. All right. In this situation, you could potentially deduct $35,000 on your return, offsetting W-2 or other non-passive income. All right. Now, if you were a passive participant only, no active participation, you did not materially participate, you could only deduct that $35,000 against other passive income, not active income. Again, don't take this as financial advice, tax advice, work with your CPA, but they should know how to do this. If not, find another accountant, all right? Now, if you want to save a significant amount of money when filing taxes, then consider being a material participant in a business or an income producing activity. Now, again, to do so, remember, you got to pass one of these 7 tests. And speaking of saving on taxes, what I want you to do now is check out my interview with Robert Kiyosaki's personal CPA, Mr. Tom Wheelwright, author, New York Times bestseller, Tax-Free Wealth. You can catch our interview right over here. I'll see you in the interview.